welcome to everyone joining today. Today's session is on the topic of Australians moving home from the US. It's all about making sure that we navigate the tax and other financial considerations as part of your move home to make your move home a success. As you're about to see, ensuring that you have a holistic financial and tax strategy, making sure you get the timing right, and also having professionals in your corner that really understand the US Australian space is really important to make sure you set yourselves up for financial success in your move back home to Australia. So, joined today by Brad Murphy from Murphy Tax. Welcome, Brad.
Thanks, John. Thanks for having me on today.
Pleasure. Thanks for joining. So just to go through some of the formalities to kick off. So, as the obligatory disclaimer we have with these financial and tax webinars, that today's session is general in nature. We haven't considered any of your personal circumstances. So if you are looking for personalized advice, please feel free to reach out to Brad or myself or another suitably qualified professional. Today's session is recorded, so if you don't get a chance to stick around for the whole session, we'll be sending a recording to everyone who has registered in the coming days. You'll also see a Q&A box at the bottom of your screen as well. So please feel free to send any questions through as we have our presentation today. We'll endeavour to get to as many of the questions as we possibly can, and any questions we don't get to, we'll aim to come back to you in the coming days. So just to introduce myself, so I'm John Versace. I'm a director, head of Expat Services, and a senior financial advisor here at Apt Partners. Apt Partners is a national advice firm, so we've got offices across in Melbourne and Sydney predominantly, and it's a firm that looks after clients with varying circumstances, but we have a division that specialises in looking after individuals that have a cross-border aspect to their financial affairs. But in particular, US Australians is where we've had a lot of experience and built a strong reputation over time. Because as you're about to see, there'll be some things that you've got to be very careful with when US and Australian taxes and financial matters are blended together. So, our approach is that we do full financial strategies for our clients, looking at your full financial affairs, and then we're there ongoing to make sure that you're making the best of your financial decisions and staying on the right track. We can't do one-off advice typically, but we can do a holistic strategy, and then there to support you on an ongoing basis. So I'll throw over to Brad to introduce himself and his role.
Thank you, John. So we're a specialised Australian international tax firm. I'm a director at Murphy Tax Lawyers and Advisors. So similar to John and his team, we specialise in helping Australian expats navigate the tax circumstances or planning with their move in and out of Australia. We have a particular focus on Australia and American taxes. So we do a lot of tax planning for Australians coming back from the US or US citizens moving down to Australia. So it's a real niche market, giving joint integrated Australian American tax services. We do tax planning, we do tax returns in the US and Australia. So really all things American and Australian taxes is how we can help.
Perfect. Thanks for that, Brad. And importantly, we work really closely together. So where there is a joint tax and financial planning need, which is often the case, Murphy Tax and Apt Wealth can work together very closely and also bring in the US professionals where appropriate as well to make sure we've got a holistic offering and can incorporate tax and financial advice as part of one process. So getting into the content of the presentation today. So first things first, we get a lot of questions of where you should be building your assets and what assets you should be building. Is it in the US you build your assets, or is it in Australia that you build your assets? And the answer is that it depends. And really, it's important to look at those points that are on your screen there. So first things first, looking at your stage of life and your risk tolerance. So if you are approaching retirement or in retirement and have a low threshold for risk, then might be looking at more defensive style assets like your bonds and fixed interests, and trying to minimize the risks associated with your investments as much as possible. Whereas if you're younger and have a much longer time horizon to invest, then it might be looking at being a little bit more aggressive and looking at more of a share and property allocation to your portfolio. Access to capital is really important. So when you're going to need to draw on the capital, if it's going to be within 1 or 2 years, then it might be looking at cash and other fixed interest type investments. Whereas if you've got a longer time frame that you need to access the capital, then you can look at other growth assets and let them go through their natural volatility that financial markets tend to have. But specific to US Australians, the last 3 points on the screen there. So navigating US and Australian taxes is really important. Making sure that we think of this holistically and navigating the issues that can present themselves with US taxes in Australia and Australian taxes as they apply for non-residents and also for US assets. So there are some important considerations that are very different to just your regular Australian that you need to be across and should dictate where you build your assets and what assets you should build. It's really important that you look at your net position of any investment and what is your after tax and after cost return on investment to make sure that you're making the most of your financial setup. So we'll talk about that through the session today in more detail. Looking at what your purpose for investing is and when and where the goals are going to take place is really important in dictating where you build your assets. So, for instance, if you're an Aussie living in the US, you're over there for a couple of years, but life is to be back in Australia, and that's where you're going to be achieving your financial goals. It's likely to be in Australian dollars, and that kind of dovetails into that last point there about currency exchange risk. So, if you're building all your assets in the US, but life is to be back in Australia, then we have to think about the currency side of things and then what the long-term tax implications are in Australia and the US. So it's really thinking of where you're going to be utilizing the assets and how we minimize risk and minimize taxes and still get an investment return. So they're all things that require individual advice and things that we work with our clients on to help you determine. So throwing into the tax side of things, I'll throw over to Brad and the first really important point around US tax residency and when you get in and out of the US tax net. So over to you, Brad.
Great. Thank you, John. Yeah, so tax residency is important, I guess, both on the Australian and American side. If you're looking to come back to Australia on the Australian side, your tax residency status would normally commence on your permanent arrival from Australia. So normally on the date you arrive in Australia, you'll be an Australian resident from that point going forward. So not for the whole Australian year, but only from the date of arrival going forward. And I guess that date is quite important in that from that date, you are subject to Australian taxes on global income from that point in time. So I guess the timing of when you do commence your Australian residency can be quite important if you're considering any sort of legacy employment payments from the US or capital gains events from the sale of shares or US property. It's quite important just to consider the timing of when you do move to Australia. The US is obviously different in terms of their tax residency tests. They have three tests effectively. One, the substantial presence test, which looks at how many days you spend in the US over a calendar year period. And that's pretty relevant for most E3 visa holders in the US or H1B visa holders. If you're a green card, you're deemed to be US resident while you have that green card. Or, of course, if you're a US citizen, obviously you're US resident as well. And I guess the impact is quite, I guess, distinct in terms of how you do come to Australia. In terms of if you're a green card holder or a citizen, you still have the obligation to report your assets and income in Australia and the US back to the IRS. So the reporting requirements are certainly quite strict for those US citizens and green card holders coming to Australia. Obviously, there's a requirement to do the ongoing American tax return to report your Australian income and investments. There's obviously the FBAR reporting as well every year to do. So I think it's important to be mindful that if you are a US citizen or a green card holder coming to Australia, you do have those ongoing American reporting requirements to bear in mind. In contrast, if you don't satisfy the substantial presence test and you leave the US, for example, on the E3 visa, normally you're confined just to paying tax and reporting any US source income. So normally your Australian income is outside the American tax net, which can be nice and helpful for your planning in Australia. Also, really important to be mindful of potential US exit taxes. The US does have exit taxes if you are either a long-term green card holder. So if you have the green card for more than 8 years out of the past 15, there can be a potential exit tax if your net worth is over 2 million US to give up that green card. So certainly an important timing piece there in terms of when to give up that green card. Um, and secondly, of course, if you're an American citizen, to relinquish your citizenship would normally involve an exit tax. Again, if your net worth is over 2 million US. There are all sorts of planning techniques and strategies you can look at to help mitigate the impact through gifting to spouses or other people. But certainly something to factor in terms of your move to Australia. And just one more point, John, on the US state residency too. Just bear in mind that obviously some US states do tax on residency. New York, California are the common ones. So just make sure that you obviously had advice to confirm you're not paying US state taxes as well on your exit from the US. Yeah, so we look now at what happens when you return to Australia from a capital gains perspective. It's normally quite good news on the Australian side. So if we're looking at any shares you've acquired since you've been in America, this could be US shares or Australian shares. For Australian tax purposes, it's actually a new capital gains cost base on those shares. So what that really means, in layman terms, is that any Australian tax is only from the increase in the value of those shares after you have returned to Australia. And this is where it's actually a great tax outcome if you are a temporary resident of the US. So if you're coming back, say on an E3 visa back to Australia, any capital gain on those shares is only going to be from the increase in value after you've returned to Australia. So any gain you made will be effectively wiped out on those shares from the US. So that's a good tax outcome. I guess in contrast, if you're coming back and you're a US citizen or you have a green card, then you do remain subject to American capital gains tax on the sale of those shares. So certainly a good planning opportunity for E3 holders in particular coming back to Australia from a timing perspective. If you can wait till you've come back to Australia to liquidate any shares you've acquired, then the capital gains outcomes and tax outcomes are certainly quite advantageous. Um, I'll just touch on property for a moment. That's obviously a big topic as well. So if you do acquire a US property and come to Australia, a couple of points to be mindful of there is that the US gives a main residence concession if you've lived in the property for 2 years out of the previous 5 years, where you can exempt 250,000 of gain or $500,000 if you're filing as a married couple in the US. So I think just be mindful if you are moving to Australia with US property, that 2 year period is quite important to get the US exemption from capital gains tax. Um, but certainly very much quite common for our clients to have US property and move to Australia. On the Australian side, the outcomes are quite positive in that you get a new cost base again on that property when you move to Australia. So normally, if you're coming to Australia with American property, any capital gains will only be on the increase in value of that US property after you return to Australia. Of course, if the property is rented, you would do declare the rental income in both your Australian and American returns with a tax credit to offset double taxes. But again, timing is obviously quite important if you do have property and you're looking to move to Australia.
Yeah, I guess one point as well to look at is that if it's a US property and it's in a state that does apply state-based taxes, you've got to consider that as well longer term. So that's something to consider. And there isn't a tax treaty between Australia and the individual states. It's at a federal level, so that can impact how much tax you actually pay on those specific properties as well to consider. But yeah, it generally is a fairly good outcome from an Australian tax perspective. Fair to say, Brad, with properties and coming home from the US,
Yeah.
as long as you time things right. Yeah, so
Yeah, for sure, John. Yeah, it's all about, I guess, timing and just looking at I guess what assets you're looking to liquidate and when. So, but normally good outcomes on the Australian side for sure.
yeah, and I guess Brad, do you want to work through this worked example and why timing is so important, especially with someone on a shorter term visa in the US and owning shares over in the US that are in a gain position.
Yeah, for sure, John. And probably it's a good example to go through here. We've got Rachel here, who's in the US on an E3 visa. She buys some shares. There's been a nice gain on those shares during her time in America, and she's made a capital gain of 400,000 US. If she was to sell those shares from the US, she'd basically pay, US federal, state, and net investment taxes to up to 30% taxes on those shares in the US. In turn, if Rachel was to wait until she comes back to Australia and sells those shares from Australia, while she's not a US resident, then as we discussed before, any Australian tax is only from the increase in the value of those shares after Australia. So her cost basis would be the $900,000 on those shares. So it's a potential outcome where there's no Australian tax or American tax paid on those shares. So
Yeah.
that's again where timing is important. If you've got a bit of a choice to wait till you come to Australia, it can be helpful.
Yeah, and just to illustrate that point further, someone that is in California, for example, and they're looking at that sort of capital gain. We're talking, upwards of 120,000 plus that it can add up to in capital gains tax. That if you sell whilst you're in the US, that could be the tax you pay. Whereas timing and waiting until you get home potentially can mean nil tax or very little
Mm,
tax. So very important to get some tax advice on
mm,
any of these assets as you're returning home, as you can see. Now going into superannuation, so this is a really key opportunity and consideration for an Australian returning home from the US. So the superannuation system is one of the best retirement systems in the world, and for those that aren't aware, this is largely why these tax considerations and the ability to get quite a lot into superannuation very quickly. So I'll talk you through the types of contributions and some opportunities that we see and help our clients with that are returning from the US and from abroad. So firstly, there's what they call concessional contributions or employer contributions. These are contribute or money that hasn't been taxed within the Australian tax system. So it's either your employer super guarantee that your employers are mandated to contribute in when you're an Australian employee, or it's money that you've personally contributed and you're claiming a tax deduction on or salary sacrificing into the super system. So the money that is classed as a concessional contribution is typically taxed at 15%. There's an annual limit as of 25-26 financial year of $30,000 a year that you can contribute as a concessional contribution. So that includes what your employer has contributed as your mandated super guarantee. But there's a big opportunity for Australian expats returning home in that there's what is called catch-up contributions, which are the previous unused concessional contribution cap for the previous 5 financial years are available to contribute into superannuation as a concessional contribution, as long as your balance is under $500,000 at the commencement of the financial year and you meet the age qualifications that are on your screen there. So typically for a returning Australian expat that's been overseas for a number of years, if you haven't been contributing to superannuation, there's this opportunity to get some pre-tax contributions in, which can be a really important tool for tax planning. And it doesn't matter that you've been abroad. Uh, Migrants to the country have access to the catch-up contributions, even if they haven't been in the Australian tax system ever before. And of course, returning expats are able to access these catch-up contributions as well. And going back 5 financial years can be a significant amount that you can get into superannuation as a catch-up contribution. Here's an example. So we've got Fred, who returns to Australia in July 2025 after working in the US for 10 years. And his balance on 1 July is 375,000. So he's well under that $500,000 threshold. He didn't contribute in his time over in the US. Now, in the next financial year, so the 25-26 financial year, if Fred was earning $220,000 for employment income in Australia, without the super contributions, he would be paying around $69,500 in income tax. Now, what Fred would have the ability to do is contribute $137,500 from his savings into superannuation, which is the total of his catch-up contributions if he hadn't been contributing the previous 5 financial years. That brings his assessable income right down, and it means the tax that he would pay to the ATO on his assessable income would be 17,188. So you can see a drastic reduction in his assessable or his tax that he pays. Fred also then has to pay the 15% on this contribution going in. So 15% on this 137,500. That equates to 20,625. So total tax between the income tax and the super contribution tax is 37,813. So the total net saving is 31,725,000. So it's $725. So it's a significant saving that you can make from utilizing this catch-up contribution, and is a real key tool that we look at for returning Aussies. It's a tool to minimize capital gains tax. So if you're selling a capital asset, say a property in Australia that has a large gain position against it, that can also be a means of reducing the tax that you pay on that property. And it's also, if you've got a large income, it can also be a really quick and effective way of reducing the amount of tax you pay in that first year back in Australia. So that's
Yeah,
it.
I think John, the other way it can be used is getting your US retirement plan into the Australian super environment as well, which we'll come
Yes,
to in a moment. There's obviously no option to move it directly to an Australian super fund, but there is this indirect method using the catch-up contribution strategy, which we'll come to as well.
definitely. It's a great strategy to potentially bring across a US retirement plan. But the other way you can get money into superannuation is through what they call non-concessional contributions. So this is money that you've already paid tax on. It's after tax dollars. You can put $120,000 a year into superannuation, or 360,000 by bringing forward the next 2 financial years allocation of contributions. So you can get, as you can see, quite a lot in very quickly. There are some restrictions if your balance is over certain thresholds. You may be restricted on the non-concessional bring forward rule if you have 1.76 million or more. And also, you can actually contribute up until age 75 as well. So it's even if you've retired, you can still keep contributing this non-concessional contribution. So for returning expats that want to make sure that they're boosting their retirement savings in Australia, you can get quite a lot in quite quickly. And the benefit of superannuation is that it gives you some immediate tax benefits, but what it also does is allows you to invest in a very low tax environment. So the maximum income tax or tax on investment earnings within superannuation is 15%. There may be some higher taxes for those that have over $3 million in their superannuation, but 15% typically for most Australians. And then in retirement, when you commence an account-based pension, it's a completely tax-free environment. So no tax on the investment earnings, no tax on the drawdown of your superannuation either, which is very, very unique to Australia. And that's why superannuation is one of the best retirement schemes around the world. And I should point out, putting in these contributions, the 120,000 non-concessional contributions does not attract the 15% contributions tax. It is a tax-free contribution into your super because you've already paid tax on that money, and it's deemed as a non-concessional contribution. So where you need to be careful, and where the timing again comes into this is for US taxes and how they would apply to superannuation. And I'll premise this by saying that the IRS have never come out and said this is exactly how superannuation is to be treated from a US tax perspective. So you will get different opinions out there from different US accountants, and it's just because there's really no specific guidance from the IRS in terms of superannuation. But we're just going to talk through some general concepts of what we see. Many US accountants apply. So, and many of you will be either in the US right now and under the US tax system or coming home on a green card or being US citizens. And this is where you need to be really careful with superannuation and some of the strategies that we worked through earlier. So employer contributions or concessional contributions will always be taxed on an income tax return in the US. That's pretty universal. The US doesn't recognize that you pay that 15% going into super and it comes off your assessable income on your personal income tax return. So that's the first thing to be aware of. So those catch-up contributions I was mentioning may not be as effective if you are subject to US taxes. Now, again, this is depending on who you speak with, but in terms of your voluntary contributions, if they exceed what your employer has ever contributed to super, then it may trigger what they call a foreign grant or trust from a US tax perspective, where you essentially create a foreign trust. The IRS would just look through the structure, tax all the investment earnings within the super fund on an individual tax return each year. Creates a whole lot of extra reporting and compliance that you need to do to the US. So you want to be very, very careful if you're ever going to trigger that. Most instances, you wouldn't want to trigger that treatment. That's fairly universal, fairly consistent we've seen from US tax professionals. But again, always speak to your US professional. I think with any superannuation strategies, that the really important point here. The US will want to tax the investment earnings in your super at some point. So whether it be on annually with the accumulation of your super and the earnings each year, or on drawdown when you draw out of the superannuation account. And that will depend on various factors, but the ability to have tax-free earnings in retirement by commencing account-based pension may not and probably won't apply if you are subject to US taxes on your superannuation, because the US will have its own tax treatment of super. And often it'll be on the drawdown of superannuation we see that the earnings of your superannuation will be taxed. And then self-managed super funds, again, this foreign grant or trust treatment, that the IRS would typically look at a self-managed super fund and class that as a foreign grant or trust, where they look through the structure. And there's all sorts of issues in terms of the investments that you own within the super fund and how they may be classed, because they will look at what the underlying assets are, which we'll come to a bit later, around passive foreign investment company or PFIC. And it will create extra reporting, extra compliance. So again, self-managed super, you need to be very careful. And if you do go down the self-managed super fund path, understanding how the US would tax the underlying assets is really important as well. So managed funds, ETFs can be extra problematic for a US taxpayer. So, so just some underlying or overlying considerations, that if you are a temporary resident in the US and you're wanting to contribute to retirement system, there's consideration around waiting until you come home to Australia before you contribute. I showed you before that there's a lot of opportunity to get money in quite quickly, and where it provides the maximum tax benefit in making those contributions. So delaying, timing those contributions, waiting until you're out of the US tax net may be the best strategy. Beware of self-managed super funds and large voluntary contributions, whether that creates a foreign trust from a US tax perspective, which will make things much more complex and may unwind a lot of the benefit you get from superannuation. If you're a US citizen coming back to Australia, it's being strategic in whose superannuation you contribute to. If you've got a non-US partner, this is a really common thing that we look at, of the strategy around contributing to the non-US partners' superannuation rather than the US citizen or US green card holder, because they will maximize the benefit of the superannuation system and not have US eyes over the superannuation, which means that you can get the best tax outcome. Consider SMSF and the implications of that from a US tax return. And if you do go down the path of an SMSF, having a more direct style portfolio, which doesn't have non-US managed funds and ETFs, is really important. And then the last one, superannuation rollover, you'll get different opinions from different professionals, but definitely speak with your US tax professional to see what their treatment would be of a rollover. before you do that if you're in the US tax system, because there's differences of opinions there, and you just don't want a nasty surprise. So now we'll go through US retirement accounts, which is a really important consideration, of course. So over to you, Brad.
Yes, thank you, John. Yes, obviously a big topic, US retirement plans and how to, I guess, optimize those from Australia if you are moving to Australia with a 401k, a traditional IRA, or even a Roth IRA. There's really a never a one size fits all approach to how to manage this. I mean, obviously, the ATO and the IRS do not recognize super funds in each country, so it's not possible to actually transfer your 401k or IRA directly to an Australian super fund, unfortunately. But I guess that there are ways you can sort of do it indirectly by using that catch-up contribution approach that John mentioned. So I think there is a way you can get your US plan to Australian super, but it just involves, one more loophole to get, or one more step to get through to get there. But it can be done. And I think the treatment is very much different depending on if you're a US citizen versus a non-citizen. And we'll touch on that firstly. So if you're not an American citizen or not a green card holder, so if you come to Australia on an E3 visa, or you're giving up your E3 visa, for example, the taxing rights actually fall to Australia on a distribution from a US plan. So under the tax treaty, if you take out an amount from your 401k or IRA, then actually the ATO have taxing rights over that retirement plan, not the IRS, which is a bit counterintuitive, I guess. So that really means you need to look at A, what would be the Australian taxable component of that plan, and then B, how to best manage the US fund as well. So Australia would basically tax you on the growth component of that US plan. So for a 401k, the contributions that you paid into it on, or your employer has paid into it are not taxable in Australia. So any growth or earnings component above those contributions is what's taxable in Australia. Um, as mentioned before, if you're not a US resident, you can actually give the fund, so it's Fidelity or Interactive Brokers or whoever, a W-8BN form to claim zero withholding tax on that payment, given you're living in Australia as an Australian tax resident. We see the funds take, different approaches to honouring that 0% withholding tax. Some will apply it and some won't. The funds are certainly conservative these days, and some funds will say, look, you got to sort your own taxes and file an American return to claim back any withholding taxes if there was a payment. So I think having that W8 bend done correctly and accurately is quite important. But I think that could be a potential very good tax outcome for somebody leaving the US and looking to come back to Australia and take out that 401k or IRA early. Because it can be possible to actually alleviate or avoid that 10% early penalty as well, just given the way the tax treaty works. There can also be benefits to doing a rollover from the employer 401k environment to an IRA environment. The ATO actually come out and said that by doing that rollover from a 401k to IRA before you move to Australia, it can reset the cost basis. That's been upheld by the tax office in a couple of rulings in Australia. Certainly not sort of binding advice, but certainly there could be a way to optimize that rollover from a 401k to a traditional IRA to get a better tax outcome when you pull it out from Australia. I guess the other point too, there can be some benefits having that plan out of the employer environment into your own personal IRA, where you can choose investment outcomes that sort of suit your personal needs, and obviously chat to somebody like John in more detail about those options. But there can be some non-tax outcomes or benefits in having it into an IRA outside the employer sponsored environment as well. If you look at a Roth IRA, that is obviously a tax-free retirement plan in the US, where effectively the post-tax earnings can grow tax-free from US taxes, and you withdraw that tax-free from the US once you're over 59 and a half. Unfortunately, Australia would not recognize that Roth IRA treatment, so it's a bit of a mismatch there, which is very common for any US clients abroad. So I guess having a Roth IRA and coming to Australia long term is not probably the best spot to be. And certainly something to factor in before coming to Australia in terms of how to optimize the Roth IRA. The other point would be that the treatment is very much different. If you're obviously a US citizen, you do pay US taxes on a IRA or retirement fund distribution. So the goal there for US clients in Australia is to really make sure that you're not out of pocket anymore in Australia. There'll be a tax offset in Australia for the US taxes paid on those distributions for US citizens. And also by doing a more sort of annuity type strategy and avoiding a large lump sum in the one income year. The goal would be really to make sure that the Australian taxes you're paying don't exceed what you would pay in America on that distribution.
Yeah.
I think as John mentioned too, there are a number of ways to skin the cat here in terms of how you do plan for retirement in Australia. Um, and I guess the options could be utilizing your US plans from Australia, which you can most definitely do as a US citizen. You can definitely retire in Australia, optimizing that US plan, and that the taxes can certainly be managed. And then look at is it an option to get some of that into the Australian super environment through a spouse or other means. And then thirdly, you could look at the more straightforward option of investing in the US stock market, for example. So there's certainly never one size fits all approach to this.
No, exactly. That's
Yeah.
it's a really important point. And it is really a key of why it's important to have advice from professionals that understand both sides of the fence in the US and Australia. So Roth IRA, very popular in the US, and you can see some really great tax outcomes from a US perspective. But when Australia applies their tax lens to the Roth IRA, it's not quite as effective. So it's similar to superannuation. It works in one system, has different implications in the other system. So whether the Roth IRA comes out before you come to Australia, in certain circumstances, that might be a consideration. If it means that you minimise your tax on the drawdown. So making sure that you speak to someone like Brad, and also making sure that with we see a lot of strategies with US advisors that may not quite understand it, looking at minimizing the tax on drawdown of a IRA and looking at some backdoor IRAs, but then again that may not be effective because of the way Australia looks at it. So getting the advice from professionals that understand both sides is so important in this. Um, so another concept to be really aware of, and it applies, it's a US tax term and it applies to non-US managed funds, non-US ETFs, or anything that's an indirect style investment. So there's the technical definition on your screen there. So it's really important for Aussies that are still in the US tax system, living in the US, or who have citizenship and or US citizenship and coming home to Australia, or have a spouse that is a US tax resident, or US citizen that's going to continue paying US taxes, to be really careful what sort of investments you hold in a US taxpayer's name outside of the US. These are the common definitions or common asset classes that can cause a problem from a US perspective when they're owned outside of the US. So ETFs, which are really popular. So a Vanguard type of ETF that's domiciled outside of the US. Stapled securities, which are Australian company stocks, but are set up in part unit trust, part stock. So Transurban would be an example of a stapled security that you've got to be careful with. Listed investment companies, Argo or Australian Foundation Investment Company are examples in the Australian market. Managed funds, so any kind of pooled investment structure or a colonial first state investment or something similar, where it's a fund manager that has an underlying mix of assets can be a problem. And property trusts, or REITs as they're known. They're examples of assets that, whilst you're in the US tax system and they're owned in the Australian market or anywhere other than the US, can be problematic, extra reporting, and usually a much higher level of tax that gets applied to those investments. So our approach is usually to make sure that we avoid those sorts of investments for a US taxpayer. So either having US domiciled ETFs that we can access through the Australian market, and there's a select couple of those that we can do, or very direct company stocks. We'll typically get around that treatment, but very important to, again, look at the timing of when you are purchasing these sorts of investments whilst living in the US, but also if you're coming back and going to continue paying US taxes, or your partner's going to be paying US taxes, being really careful of this. Now, superannuation, is a really important point. So usually superannuation will be made up of managed funds. If you're in just an industry super fund, if you're a US taxpayer, that usually isn't a problem as long as you don't trigger a foreign grant or trust. So if you trigger a foreign grant or trust that we talked about earlier, which was a self-managed super fund, or if you've contributed more than what your employer has ever contributed, then that's when the IRS will typically look through the fund and say, what do you actually own in here? And they will look at whether you've got managed funds or ETFs, and these PFIC issues will present. If you've just got a regular super fund, you haven't contributed more than what your employer's contributed, and you're still subject to US taxes, it usually won't trigger this treatment, but that's something to look at and get advice from a US professional again. Now, currency exchange is a really important area to think about when you're coming home. So this is why it's really important to do your planning early, as early as possible, because if you can incrementally bring assets home to Australia, if you're planning a move in the next 5 years, then you'll give yourself the best opportunity to potentially manage the currency exchange side of things. So we do a lot of work around the currency exchange side of things and in our strategy and advice for our clients. The key point is that it's impossible to time. There's so many different factors that influence currency exchange markets. We sometimes get the question of what's the currency exchange going to do in the next 6 months? And it is a real crystal ball type question because no one really knows with all the different factors that influence it. But the most important thing is to look at it from a risk management perspective. So right now we sit around here, which is between the or around the 65 cents. So 65 cents for one Australian dollar. So the average is somewhere between 80 and 70 cents, around that 75 cent mark is where the long-term average, depending on what time period you're looking at. So right now, it's better than where it's been historically, on average, if you have got US dollars that you're bringing home to Australia. It's been better in recent months, but it's still a pretty good outcome looking at history. The thing that you really want to avoid is this period in time, 15 years ago, when the Australian dollar was dollar for dollar, and it wasn't a flash in the pan type moment. It was really from 2007 all the way up until around 2016, that the Australian dollar was elevated well above where its historical trend is sat. So you've got to be prepared to either leave the money in the US long term. If you're building assets there and want to keep accumulating assets in the US, there is this risk of this outcome in future, or incrementally getting the money home and trying to average out the currency over time. But as I mentioned earlier, you've got to look at, if your goals are in Australia, you've got to look at Australian dollars that are going to satisfy those goals and converting your asset pool, if it's in foreign currency, back to Australian dollars. And it is an extra element of risk if you have assets in foreign currency that you've got to navigate. There's important elements of accessing foreign markets, which give you a lot of differences from what the Australian market can offer. But there's other factors, including tax, currency exchange, that you've got to factor into your thinking and financial strategy as well. So that's something we advise our clients on and work through as part of the broader thinking. So that's it in terms of the presentation. So we'll throw over to some Q&A. So there is a few questions here. The first one is the definition of earnings inside super, income versus capital gains versus unrealized capital gains. And it's a good point. Firstly, from an Australian tax perspective, from superannuation, there's very clear definitions between those three elements. So income is taxed at 15%, and then capital gains is taxed at 10% if you've owned it for more than 12 months, the asset. And then unrealized capital gains typically are not taxed at all within superannuation. Now, from a US perspective, it gets more complex, where really they're all kind of bundled together, and the earnings can be just taxed on a US tax return at income tax rates, is our experience. And There is the potential in certain circumstances for unrealized gains to be taxed. If you're a significantly compensated individual, potentially that can be means um, for your unrealized gains to be taxed on your US tax return. But most of the time, it won't be. It'll be on drawdown, but it really depends. It's a bit different on the US tax side of things, but from an Australian side, very clear that the income is a maximum of 15% as long as you're under that $3 million cap, as that law's likely to change in the next little while. 10% on capital growth that's realized and no tax on unrealized gains. Um, there's another question here, Brad, if there's any advice on a US HSA, Australian on E3 eventually planning to return to Australia. Um, yeah.
Yeah, I mean it's a good question. Quite a common question actually. I mean, I think technically speaking, the ATO would tax you on the growth component of that HSA. So contributions would not be taxable. The earnings or growth would be when you do use it or cash it out. Um, and then I think obviously you could use it for qualifying health expenditure, I believe, in Australia. So I think certainly it could be used from Australia. I think in practice we see most people just tend to use it before they come back to Australia on US health expenses in terms of yeah, qualifying expenses in America. But I think conceptually it could be used and spent in Australia. Yeah.
Perfect. Thanks for that,
Yeah.
Brad. And we've got another question on options and RSUs. So, did you maybe want to go through options and how that can be taxed if exercised before coming home versus exercised after coming home, and also RSUs and how they're taxed if you've earned RSUs whilst being in the US system.
Yeah, I mean, obviously very common for Australian clients to work with employees in America offering options or RSUs. Effectively, you would normally pay US income taxes on the value of the RSUs, or when you exercise the option on the value of the shares you're getting at that time. So yeah, basically you're normally subject to American income taxes on what we call the spread, which is really the value of the shares you're getting less what you paid for those shares to exercise the option or what you paid for the RSUs. The good news would be that if you did decide to come back to Australia and you've actually paid that income tax, so to say, for example, you've got some shares in Google, for example, you pay the income tax in America. That means that any future gain is on capital gains account. So if you hold those shares long term and come back to Australia, then any Australian tax again is only on the value increase of those Google shares after you've come back to Australia. So the timing here is quite important. If you're happy to or willing to wait until you come back to Australia to sell those Google shares, you can avoid American capital gains tax and get some good outcomes on the Australian side. I guess it's a bit more, I guess, messy or complex if you actually got the vesting period happening in both America and Australia. That's when effectively you would basically source the employment days to the US and Australia and pay income tax based on where you're working over that respective period between the date of the option to the exercise of the option or share.
Yeah, great. Thanks for that, Brad. And there's another question on estate planning. So, do you need to have a will in the US if you maintain a property in the US? So, it's a good question, and
Mm,
um, typically we would say yes. You should have a US will if you look to keep a property asset in the US, and then have an Australian will in Australia that covers the Australian assets. Making sure that those wills kind of speak to each other. There's a common term that's used in more generic wills that will say that this will revokes all previous wills. So if you're going to have two wills, that will often negate the other country's
mm,
estate planning documents. So you certainly want to make sure that your solicitors are speaking to each other. But it's usually considered best practice to have a will in each location and ensuring that your professionals are kind of collaborating. There is a possibility of an international will we've seen, but certainly making sure that you speak to a professional that's experienced in these cross-border um, uh, asset estate planning matters, and making sure that the wills kind of speak to each other and are going to be recognised in each jurisdiction as well. Um, and then Brad, there's another question on if you move home and you've got a US primary residence, how that would be taxed under the Australian system, whether um, the Australian exemption on principal place of residence would apply or not. Are you able to speak to that one?
Yeah, definitely. Yeah, it's good question. Again, a very common question. Yeah, it might be that you obviously have a chance to sell your US property before you come to Australia due to, it's the wrong season, for example. I know most clients have to try and sell in spring. Um, Good news would be that you can actually apply the Australian main residence concession on that property. So if you actually don't have another property in Australia as your main home, you can actually apply the Australian exemption from capital gains tax on that American property. Um, if you did have another home in Australia, then you nominate what property you want as your main home for tax purposes. But also, as we touched on before, it's actually quite good news when you come back to Australia because you get that rebasing for capital gains purposes on that American property. So any Australian tax is only going to be on the increase in value of that US home anyway from your date of arrival in Australia. So just make sure you get a valuation done by a qualified real estate agent in America that sets the valuation with the ATO, but normally quite good news in that scenario coming back to Australia with a US home. Yeah.
Great, thanks for that, Brad. Question on US investment account. So US investment account via E-Trade, can this be maintained on return to Australia, or can we hold long term or keep trading? Do we have to liquidate? What are the tax implications? So, very good question. Now, from a pure tax perspective, there is nothing against you holding an E-Trade account and continuing to maintain that and continuing to trade. So one thing that may apply is that if you're a non-resident, there may be some withholdings tax that gets applied to any asset sales or any dividends within the E-Trade account. It's also worth checking with E-Trade themselves and whether they will still allow you to maintain an account. It's often between both countries. It's often a case that the providers, not through any major legal issues, but more so just for their own anti-money laundering and their own personal compliance, that they just want to make sure that they don't deal with individuals abroad, just because it's a lot easier for them, you know, basically, that they may not let you keep that account. Others certainly will, and there's plenty of US providers that will let you maintain an account whilst you're living abroad. From a tax perspective, from an Australian tax perspective, as Brad mentioned, that capital gains tax would be applied from an Australian perspective on the day that you return. So essentially, or you would be assessed as having purchased those assets on the day you've returned, I should say. So any gains that happen whilst you're a non-resident for Australian taxes won't be considered in the Australian tax system. It would be the gains from the day that you've returned forward when you eventually sell the asset. So that's the treatment. As long as you held those or bought those assets whilst you're in the US, if you bought them before you left Australia, then it's consideration of whether you deem disposal of those shares when you left Australia. But that's something that would be on an individual basis. But typically, anything that was bought whilst you're in the US out of the Australian tax system, the cost basis and what you're deemed to have purchased those investments would be the day that you return to Australia going forward. And the US treatment will depend on whether you're still a US tax resident or not. But you can certainly still maintain that account. But I think that is basically it. There was a few other questions, but we'll possibly reach out and get to those individuals. They're a bit more personal in nature. So we might wind up the session, but thank you to everyone joining. You're most welcome to reach out to Brad or myself. We'll send an email communication with our details so that you can reach out to us if you'd like personalized advice, and you'll also get a copy of the recording after today's session. thank you, Brad, for joining the session today and providing your valuable insights.
Yeah, thanks, John. Thanks for having me. Yeah, really enjoyed the session.
And
And yeah, if anyone's got any questions, please reach out and definitely can organize a consultation to discuss further.
excellent. Well, to those in the US, have a great evening and thanks for joining. All the best for your move home. Bye.